Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our weekly commentary on financial markets. Let's get started. This week's Market Insights is going to summarize our 2021 outlook, which we have more fully explored in our Strategic Insights publication. So, what are we thinking about 2021? It's best summarized in the title of our Strategic Insights piece, Building Towards a Bubble. We believe that in 2021, the conditions could finally fall in place for a euphoric bubble in U.S. equity markets. Now, why do we believe that to be the case? We believe that bubbles occur when a wave of newly printed money hits a fundamental rationale that helps justify higher asset prices. Now in 2020, we absolutely had that wave of newly printed money because 21% of every dollar ever printed was printed during 2020. However, we also had COVID. We had systemically high jobless claims near record levels from April all the way through the end of the year. These kinds of depressing economic conditions mean that for most companies, it was a year where it was hard to justify higher asset prices. Now that doesn't mean there weren't selective pockets of euphoria. If you were a company that benefited from COVID, an Amazon or a Netflix, yeah, absolutely. You had huge gains and huge euphoria. But for the broader economy, for the broad stock market, you didn't have that fundamental justification for higher asset prices in 2020. We think that's going to change in 2021. We think in 2021 we could have an explosive recovery in the broader economy. And when you take that explosive recovery in the economy and therefore corporate earnings, you create that fundamental justification for higher asset prices. And just as in 2020 there was a ton of money printed by the Fed, in 2021 we anticipate that the Fed is going to keep those money printing presses rolling because we have an incoming Treasury Secretary, Janet Yellen. She and Jerome Powell, the Fed chairman, they are an absolute dove fest when it comes to fiscal and monetary policy. They're both on record as believing that the risk for the U.S. economy is not doing too much to stimulate, but doing too little. They believe that the inflation bear has been killed by technology and by demographics, and they believe that you have to run a high pressure economy with super low unemployment if you're going to lift wages for working class, lower income workers. So all of that means that you have the two most powerful people setting monetary and fiscal policy. They are in complete agreement that it is pedal to the metal for 2021. We think we're going to see a COVID-19 stimulus package probably in the lame duck. We're going to probably see a big infrastructure stimulus bill, and we could see a third COVID stimulus early in the Biden administration. That is a lot of fiscal policy, all funded by a lot of money printed by the Federal Reserve. And then there's what's happening in the real economy, where COVID vaccines are going to be broadly distributed by June. We've got huge savings, record savings levels across the U.S. economy, concentrated in higher income consumers without question. But in addition to record savings, you've got great wealth effects that incentivize those higher income consumers to go ahead and spend because they've made a lot of money in their stock portfolio and their home prices are going up. We think that the Biden administration early on is going to push for an increase in minimum wage, which seems to have bipartisan support. That's going to lift wages for ordinary people. All of those things are going to hit in 2021 with this fiscal stimulus, with this monetary stimulus. And last but not least, aren't we all ready to go out and have some fun? There is some pent-up demand after the lockdowns of 2020. We think that 2021 economic growth could shock people with the power of the economic recovery. with the explosive growth in corporate earnings, and that creates the fundamental rationale for higher asset prices that, when it combines with all that printed money, creates the conditions for a bubble. And unlike prior bubbles, this one could inflate higher and last longer than history would suggest, because what central bankers learned from Japan in the 90s and the US housing bubble in 2008 is don't pop bubbles. If you do, terrible things happen to working class workers and the general economy. So we think if we get a bubble, central bankers will tiptoe around it. They're going to do everything possible to avoid popping it, which means this bubble could have staying power that we haven't seen historically. Thanks for joining us for Market Insights. We hope you found it informative. If you'd like more Caravel research, you can get it on our website, caravelconcepts.com, or you can subscribe at the link below. Thanks.